Great. We see you all joining. Thank you and welcome. We are rolling. I am J.Thelander, founder and CEO of J.Thelander Consulting, currently sitting in Miami since we have a global panel. I guess it's good to say where we all are. I'm in Miami, Florida, and it is exactly 9 o'clock in the morning. And the protocol for today is we're going to introduce ourselves. We're going to have Wendy give us sort of a state of what's going on from BIA and an update in terms of the UK market. And then we'll get into some discussion and data. We would love for this to be interactive. So if you all have questions as we're discussing and you'd like to put that in the chat, Morgan on my team is monitoring that. So we will address your questions and make sure that we try, and there'll be Q&A function. So if you could use that, that would be great. So I'm going to pass this over to Nicola Squire, who is at Cooley. We've been a great partner of ours. I just came from your Cooley conference in Palo Alto last week, the Health Tech Conference, which was phenomenal. So I know you are sitting in London. So Nicola, introduce yourself and glad to have you. Thank you.
Fantastic. Thanks, Jodie. Hi, everyone. I'm Nicola Squire. I'm a partner in our compensation and benefits group here in London. I'm a UK lawyer, but help our companies through the entire life cycle, both UK companies, US companies, and on kind of global expansion. It's great to be here. Thanks, Jodie. I'll hand over to Nara to introduce herself.
Thank you so much, Nicola. Thank you, Jodie, and thank you to Wendy as well for being a co-panelist. My name is Nara Daubeny. I'm the CEO, Chief Executive Officer of Fame Pharma. We do novel first and best-in-class therapies in autoimmune disease with a lead asset in type 1 diabetes that is disease halting and life transformational. My background is I'm a doctor both by training and by PhD, a surgeon with an ENT and an immunologist, and really excited to be here amongst such a fabulous company, and thank you to J.Thelander Group for putting it on. Wendy, if I hand over to you.
Thanks, Nara. So hi, everyone. My name is Wendy Quano, and I'm the Data Insights Exec at the Bioindustry Association. A lot of my work, I do a lot of financial analysis within the biotech sector. So that's kind of what I will be covering within this webinar. So just a little bit about our collaboration with J.Thelander. Our members were keen to have access to real-time compensation data, both for the UK and the US. So we engaged with J.Thelander through a recommendation, and we actively promoted the platform to our members so they could contribute their data, because once you contribute your data, you have access to benchmarking data as well. And we hope this will, provide useful information for our UK biotech teams, as well as providing transparency across compensation levels, especially around the gender pay gap. And speaking of that, we actually did a collaboration with J.Thelander for our Women in Leadership report that we released in March, and all our US C-suite level data was given to us by J.Thelander. So we have a good going relationship. So to kick off this webinar, the BIA produced the Q1 financing report for 2025. So I'll just give a quick insight into what we covered. Let me share my screen. Yep, so just a quick overview. We publish our reports annually with quarterly updates, and it's based on innovative companies within the UK. And our data is sourced from H2 Radnor, Sightline, PitchBook, Bowhurst, and London Stock Exchange. So just at a glance, in the first quarter, we actually raised £881 million in venture capital, which is a good start to the year, especially comparing to the same time a year ago where we raised 240 million. However, our public financing fell sharply to 43 million due to investor caution and macroeconomic factors. And our IPO continues to remain stagnant at no companies going public. So yeah, Q1 of 2025 was actually our largest quarterly raise since Q2 of 2021, which is very impressive. However, this was highly influenced by two mega deals from Isomorphic Labs and Verdiva Bio. So this is showing investor caution because the distribution of investment is very concentrated. And if we look at these pie charts, we can see that the deal count was quite low. We had a total deal count of 15 deals compared to 21 from the previous quarter. So deal counts have sharply dropped. And we can see that the distribution across investment stages isn't that great, as most of the deals happened in non-disclosed deals, and the largest sector was non-disclosed deals as well. So not too great because the concentration is highly at earlier stage compared to later stages. And if we look at an international perspective, we can see that the US continues to dominate within venture capital. The UK, however, continues to lead Europe. However, we can see there's a clear disparity between the UK and the US. And, in order to close this gap, we do need the help of policy making and investments to essentially improve. But yeah, thank you. And I'll hand it back to you, Jodie.
Perfect. Thank you. Well, I mean, that's a great way to kick it off because, I mean, I don't know about all of you that are listening, and of course, my fellow panelists, we sort of know this, that there are deals being done. The deals are really good deals, and there's money being deployed. It's just going to fewer companies. I don't know, Nara, you have a thought on that? I know you're right in the midst of this industry on the actually on the company side.
100%. I mean, I think that the graphs really sort of tell the high level tale, but the sort of the granularity at the coal faces, it is very tricky if you're looking very early on in the investment in your investment pathway to attract that substantial capital at this point, which will feed into our later discussions on how do you get the team around you, because the number one way to get that capital in is with the team. People either who have been there raised before and or have got industry expertise within that. So that's 100% borne out by that. So, if you've got that traction, and if you were lucky enough to have had that traction when the sun was shining and we were all making hay in, say, 2021, then coming for that relatively big muscular Series A's, accepting that some of those Series A's are smaller than they were then, it is that much of an easier, not easy, but easier ask. So I think I agree with that.
Yeah. Nicola, did you have a thought on that?
Yeah, I mean, we're certainly on the legal side. We normally get involved at term sheet stage, so appreciate that there will have been discussions that are leading up to that point that we may not necessarily see. But we are seeing deals get done. It requires patience, it seems, and there can be a bit more stop-start than back in those heady days of 2021. But it is getting there, and we're certainly feeling positive for the year.
Yeah, and I don't think it's luck, Nara. I think it's those of you. This is it. It's just getting narrower at the top. I'm going to jump in because the focus of this webinar is on global private companies and the compensation component and sort of how we all factor into that. So I'm going to, and as Wendy had said, we've had the great relationship with BIA, and that all BIA members have access to a subset of Thelander results if they participate in the survey. And we now have a separate UK filter because we see how important it is. As you can see, the US number one in terms of the deals, but in terms of Europe, the UK is the dominator. So by way of background, for those of you who may not be as familiar with Thelander, I've been doing this almost 30 years, and I've got Morgan on my team, who's also my daughter now, for almost 10 years. We had a great feature article in Forbes magazine, which was really exciting. I know it was on February 26th because that was Morgan's 30th birthday. So that really was a nice, a nice acknowledgement for all of us. And we have a great podcast that's running too, Caplander, on all things private capital markets. Nicola, we had one of your colleagues on from Rachel Goddard on the private market stuff on compensation for the investment firms. And we had rave reviews over all of that. So we'll be knocking on your doors as well to join us. But those are great episodes. Let's talk about sort of where we cover our data across the private markets. Things have gotten a little blended because, with all the AI and health tech, so we cover biotech and medical device and then different sectors of tech. And that's even more and more relevant today because you can't look at data just from one industry for all the positions because there's quite a bit of convergence. You can't believe how many tech companies are hiring scientists and other roles. So it's a competitive landscape, not only globally, but across sectors. The biggest thing that everyone touched on here is that, and Nara, you said it, like somebody's Series A. So we like to look by total amount of financing because it really represents an exact number. And there have been bigger rounds, there have been smaller rounds, but the total financing really helps you to get specific because it does impact the cash and equity mix. And also, as you can see here, I mean, we even go up now over to 500 million, that there has been, as Wendy's numbers showed, a zero on the IPO market. I mean, Nicola, what are you seeing on all of this?
Yeah, I mean, we'd all like to see those IPOs coming back, and I think we were hoping that would be this year, but let's see. I mean, certainly in the UK, doesn't seem to be happening. There seems to be more of a sense of it in the US, and we tend to follow. But we have historically done a lot of IPOs of UK companies listing in the US. So
Right.
let's all keep our fingers crossed that will be coming back. But yeah, in the meantime, companies are carrying on raising money, and that needs to happen, and that is still happening.
Yeah.
Pick up that point, Jody, actually, on some of the IPO piece, because one of the challenges, particularly for companies that have had late assets that are related down the line, that's the kind of, there's a sweet spot when an IPO is really going to add value both to shareholders as well as the existing team, and that tends to be when either you have got a mature enough asset and or you're deriving a revenue and or you have line of sight of clinical application. And one of the reasons, other than the macroeconomics and geopolitics that's involved, that has really played against the IPO market is when we did have a glut of IPOs around 21, a lot of those assets were at a much less mature stage. And
Right. So it was done as a fundraising versus a true
100%.
IPO for the purposes of getting an asset into, yeah.
And we're feeling the bite of that now because people have recognized that as a result of that, if you're trading for penny stock a few years later, then IPO wasn't necessarily the right path.
Yeah. Yeah.
It's a
No,
correction.
we've heard this as well. Wendy, did you have anything to add on that? I know you've been, really knowledgeable on the data, but you see the IPOs at zero. Any thoughts from the BIA perspective on this? Well, Wendy, we can't hear you.
Can you hear me?
Yeah, there we go.
From a data perspective, we do hope that, the US investors do start investing to UK companies, but we know that, because of the climate right now, will probably happen more closely to like the end of 2026 as opposed to right now.
Yeah, it'll be interesting to see what happens at the Jeffries conference. And I'm sure we'll have a pulse on all of that as it's become a little bit of a global place that people are convening. It certainly was really interesting last year. In terms of the J.Thelander data, we do cover the globe, right? So we cover the United States, 90% of the companies, almost 90%, but even that number is even down for us. And Europe is rising. And then within the United States, it's all over. We hear more and more that it's no longer a Bay Area, or there's obviously quite a bit going on in Boston in terms of life sciences. We see the Cambridge to the Cambridge and the Cambridge, the UK to the Cambridge, US. And then within Europe, here we go, over half coming from the UK. And here's the list of job titles that we have at J.Thelander. And I show you this because it's really incredible how many job titles, right? And everything in green you get if you participate for no charge. You get access to the platform. And there's a lot of platform upgrades coming, and I think it's really relevant to discuss because you will be able to see, to plan, and there's by year over year and by looking at the total amount of financing and putting in your data as a company and then seeing how that translates as you continue to raise capital, because with dilution and the factors of having more money come in. Maybe the rounds, as Nicholas said, are taking longer, but deals are getting done. But when you raise that capital, it's important to plan how it's going to impact your team. And it may be such that you give, look at all these jobs. I mean, so many jobs now, over 300 positions. And you may give equity to, and we'll roll into this, to everybody in the beginning, but it's unlikely you're going to continue to give equity to everybody as you continue to go through your money or you raise more money. You're not going to refresh everybody. So Nicola, I'm going to turn this over to you, and maybe you can compare and contrast for us a little bit of what goes on in the UK as well. But these are the types of equity that are currently granted. And obviously equity is the biggest carrot, right, for a private company, because that is the where there might be wealth creation and it's the long-term incentive. Nara, obviously you're familiar with it. So maybe Nicola, you could break it down for us and explain to everyone who's here what all of this means.
Yeah, sure. Thanks, Jodie. So, Jodie was just looking at that list of countries and where the companies are based. But when we're looking at equity, it's not just where the company is based that's important, but where the executive is based. And, more and more we're seeing a kind of work from anywhere, hire from anywhere sort of trend. And so the company and the location of the people aren't necessarily the same. And so these types of awards here are kind of in US terminology, but there are corresponding things in the UK, and there are certainly similar things available in most countries where people would be hiring. So incentive stock options, that's the US tax advantaged type of option. In the UK, we have EMI for those smaller startups, the most tax advantaged of the option types, and then CSOP, which is company share option plan. Also offers a capital gains tax treatment, but
right, that's the biggest advantage of the ISOs, right? So that's what most companies in the US are granting, because you get the low share price, you get it granted with a 409A valuation, and then the capital gains is on the spread.
Absolutely. And so if you have executives in the US, they're often wanting to receive these ISOs. In the UK, that would, if you qualify, be EMI options at the earlier stages, and then likely moving to CSOP once you tip out of being able to qualify to grant EMI options. The NSOs, the non-qualified stock options, that's really a catch-all for anything else. So in the US, it's either an incentive stock option or it's an NSO. In the UK, we sometimes call these unapproved, meaning that they don't follow any of the HMRC special tax advantage regimes. And then in other countries, you're typically also going to be granting unapproved NSOs, unless there is something special available in that country. So France, they have BSPCE, for example. Israel has something, a tax advantage arrangement. Denmark, a handful of other countries. So the default is normally NSO, but then it may be that if you tailor things, then something tax advantage like ISO, EMI, etc., might be available.
Yeah.
And
Nara, you had a comment on this. I know this is, you're obviously based in the UK, and you have employees in both locations, like the US as well?
Yes. So yes. Thank you, Jodie. Yes, 100%. So it's very interesting, and this is where I think actually very good legal advice and incredibly good consultancy data is really helpful to you, because you can say, this is what I am doing, and this is where my people are. So having that fantastic legal advice is imperative, because you can connect it, and you can't make fundamentally different offerings in principle, albeit it has to be suited for the geographical area. So what you're doing in the UK/Europe has to not favor or disinfavor what you're doing in the US. So the two have to talk to each other. But you're absolutely right, particularly early on, you're using this as an incentive for your team. So it has to be good enough and tax efficient enough for them.
Yeah, here's another slide. I like this one to see what's going on, because you can see the consistency. So this is looking at the equity grants by the total amount of financing raised to date. And this is a check all that apply. So you can see that maybe early on there is a little bit of use of restricted stock, and that has a totally different tax benefit to it, right? Because you don't really get the capital gains, but it's a different tax treatment. And I only know this because at the Cooley Health Tech event last week, we did, you and your colleague, Ali, and I did a session on this, talking about restricted stock and how it is used on, it is something that is being used more. But you can see that through all the total financings, that the incentive stock option is sort of the number one way.
Yeah, and in the UK, the equivalent would be the EMI. By far and away if a company qualifies, so if they're at that small early stage, then 99% of companies are offering EMI options.
Yeah, because it's not only knowing what you own, but how you own it. So it's all predicated on the right percentages, right? So just to break it down in the simplest terms, vesting for your equity awards, and the vesting is typically time-based. It could be performance-based or a mix of performance and time, but it's generally like maybe you get some time and performance-based if there is a goal to reach, but that's not the initial grant, is always time-based. And then the vesting period, 4 years. Is that the same for you in the UK?
Yeah.
Yes,
I would think so, Nicola. Don't you think that's probably the common thing to see, with different cliffs perhaps, or but
yeah,
here we go. Here's the global.
Yeah, occasionally something specific and bespoke might be negotiated for a particular senior executive if there's some kind of reason for that. And as you mentioned, that there may be performance conditions, milestones or something, but by far and away, the most common is a 4-year vest, 1-year cliff, and monthly vesting thereafter. And people understand that, and it's very common.
Right. And you can see the global, excluding US, this sample size of 77. That is really in part because of BIA. So Wendy, we have to thank you, and thank you for the pitch. But the collaboration's been really important, and we've done this for the long game. And Nara, you really just, highlighted it. It is a collaboration, and it's really important that you have the global data, because there are nuances and differences. But if you don't participate, then we don't have the data. So please, Morgan's going to put the link up. Because you do get access to a lot of this data for no charge. And it's really important that we have the data to be able to show everybody this, because you want to be able to make decisions that suit your company and your organization. And then I'm going to we do have a question, made changes to the vesting schedules? No. And then this is the last part about having a refresh and evergreen program. So Nara, maybe you want to talk about this, because you're in the operational role. I mean, from our vantage point, you got to get the equity right to begin with, and then you can figure out how to refresh from there, but you're not playing catch up. You are making sure that your key people get to be incentivized, because you can't give additional equity to everybody.
No, 100%.
Yeah. And maybe Nara, you can answer this as well. We did have a question in saying that, how do you recommend looking at premium roles higher than others, and how do companies accommodate the geo differentials? So that one maybe is a good one for you to answer.
I think what it comes down to is first of all is you've got to do a couple of things before you come down to a decision pathway. Number one is, what are the roles that you're looking to fill? Who are those people? And be incredibly clear. I suppose this is where, Jody, some of that data around these particular roles attract that is very, very helpful. Who do you need on the team to execute, and what do you need them for, and how long do you need them for? Back to Nicola's point.
That's such a good point, because that's where the 4-year vesting sort of gives you help, right? Because maybe you give somebody equity in the beginning, and then that role you move from commercialization or research into commercialization, and then all of a sudden that role, not all of a sudden, but at a certain point, maybe that person's role becomes less important because they've done a good job.
100%. So having that long-term view, sort of short, medium, and long-term view of what you want each of those roles to do, and how do you see them fitting into the company over that time. Particularly early on, you'll be bringing on people who add value for the long term. And I would argue that bringing people in for a relatively short amount of time does not fulfill the criteria for them to start having stock options per se, unless they can really move the needle on what you're trying to achieve, because then it's just a contract.
Because there's only so much to go around.
100%. And actually then, so that's one thing, is being really sort of tail can't wag the dog. You've got to be really clear of what you're trying, what you're trying to achieve. And then the second thing is then look around and see what dovetails into that sort of role once you've decided that you're hiring somebody for the long term, for the high impact. And this is where both legal advice and knowledge is incredibly powerful, because you can't offer somebody something that's way off piste. So
Right.
you see a high element of sort of conservative congruence on that data. You will see 4 years, a year's, 4 years vesting, a year's cliff, EMI stock options in the UK. And if you were to offer something quite different, to the well-seasoned executive, they'll probably question that as to why. But to be fair, I think you end up staying relatively clearly on piste if you've got that, that legal steer. So I think it all starts with the sort of an understanding of what you need, and then getting the expert advice
Of
to
what
execute
you need, who you need, and then
for how long.
all these questions have come up about, what percentage of companies do top ups for management. So, Nicola, here's my take on it, and then of course the legal component of it, or your guidance in terms of both the UK and the US, or Europe and US. So, we ask this question because it comes up all the time. If you have an evergreen program, so here we ask, did you have an evergreen program to grant follow-on refresh options? So let's say you hire somebody, and it is, as someone had said in the chat, a premium role. So that's where you would use the percentiles for a job, the 25th, 50th, and 75th percentile. We publish all that data, and we'll get into it. And you give that person the 75th percentile for their total cash, which could be a mix of base and bonus, or it's just their base pay. And you give them the 75th percentile for equity, because they're a really important person. And then they've gone through their 4-year vesting. And that means that that person was a premium role, and maybe somebody where it's a role where they're easily replaceable, or that role is not as key to your organization. So you use the 25th or 50th percentile for their total cash and equity, or you go to the 50th percentile for cash and the 25th percentile for equity. And then all of a sudden you have a financing, or the person's the as needed, right? Somebody's fully vested, but the financing is where there's dilution on that equity. So maybe I'm going to slow down, because I know this is something that I do every day, but Nicola, maybe you could break this down for us. So what happens with the dilution after the financing? What happens from the company perspective, maybe in a board meeting? Like, you can't top up everybody. So how does this factor in?
Yeah, I mean, we see this from a few different angles. I mean, one question, and the starting point has to be, and this comes back to Nara's point on the planning, is how much do you have to go around, and do you need to get a top up to your pool as part of that financing round? And clients say to us, what percentage shall we ask for? And it's almost looking at it the wrong way. It's like, not what should you ask for, but what do you need?
Yeah, here is a little bit to help you with this as well, because we go very deep into option pool. So this is for all reported data, but this number in the middle here, that 10 to 16% for the employee pool, that is the magic number, no matter what, no matter if you're at an early stage, like here's global as well, right? It's still that 10 to 15%. No matter how many ways we look at it, that's the number we come up with. Is that about right, what you see?
Yeah. And yeah, what that kind of translates into really depends on what the company needs, what the plans are for hiring, and how can you justify to your investors that you need more. So once you have your pool and you know what you've got to go around, then companies are thinking about, as you said, who should be getting this. And it may be that people have got promotions, and so although they were at that 75th percentile for the role when they joined, they're now actually way below that, and so it may be that they need a top up. And it's really about looking at the suite of employees and the trajectory of the company, and working out what you need where. We sometimes see across the board top ups, but well, as your data showed,
it's a tough one, because if you've hired more people, or Nara, as you're saying, so let's look at this data and talk through this together. So, because I really think this data tells a whole story. So here is, I'm going to go back. So we have the all reported data, and this is, hang on. I know I'm looking at it, but you're not. Okay. So this is the all reported data for option pool. And we show the buckets that we ask about are founders, employees, board members, meaning outside board members who have not contributed capital, and that could include the scientific advisory board, and then the investors. And here's the same data globally. And then here is a seed stage company. So this is where they've raised less money, earlier money. And so they got the percentiles for the founders would be predicated on how many founders there are and what percentage they own. But the main thing to see is that the employee pool is still averaging the 10 to 15%. The investors own less. As you would expect, you go through the next round of financing. And so there's dilution to the founders, the employee pool still saying in that 10 to 15%, the investors are owning more. And then we're going to fast forward a little bit later to getting to a late stage. And now I'm going to let you jump in here. So the founders are really diluted. Now, if they're getting additional equity, it's got to come from the employee pool. And of course, the investors own more. So how does this factor out for a company? Like, what's the reality of this when you go to your board? Where is it from your perspective?
I think this is great data, Jodie. Thank you for showing it. And I'm really loving that sort of temporal progress over time, early, middle, late stage. And I think what's really exciting and interesting about this is that you've got that seesaw change between the investors and the founders, as you should, as you bring in more capital, right? So the greatest thing that a founder and the initial members, the initial executive members have got to offer is obviously equity for cash. That's the whole point of investing. But what's really interesting about that is intuitively it feels right, but it's really lovely to see it borne out with the data. Everybody loves data, all scientific.
We know the story. A lot of times we already know the answer, but it does help to say, see,
but it's really nice.
Wendy's nodding her head because I'm sure you know this from BIA, right? I mean, that's part of what your leadership role is in the industry, is that you highlight and show exactly what everybody knows, but it does give a certain authoritative component to it.
100%. But it absolutely underscores the point of why we're here today, which is essentially is you have to put a value and also really value your board members and your staff and then your employees, your EMI pool for the UK. So it's really interesting because people recognize the benefit and the strength and the power that lies in getting the right people in.
Yeah,
it's great to see it in the data.
The biggest piece of it that this data shows from my standpoint in the comp element, and Nicola, I'd like to hear this for you as you're working with companies on board meetings, is that you have to be prepared to know that you need that 10 to 15% in terms of your option pool, and that you've got to plan for who you're going to compensate and where they are on their vesting and who the key players are and how all this factors in. Because when the question comes in about what percentage of companies do top ups for management and staff, or what is the typical top up, it's all predicated on where did you start? Did you get the equity right? And for that job role, and where you were in your financing. And then based on where you're headed in terms of the company and who the key players will continue to be, what do they need? Because obviously the equity is the biggest component. So if we look at this other piece of this, the percentage is reserved for future option plan, granted annually in refresh grants and granted annually in new hires. This could be part of that 10 to 15% pool, or it might be in addition to it. But obviously companies need to plan for their board discussions and where you are on all of this, because there's no one answer, because it depends on how good of a job you did to begin with.
Yeah, and obviously, even if that 10 to 15% is remaining relatively stable through the life cycle, it's likely that it's being shared more broadly. You've got more employees, more grants, and so it's not that initial 10 employees are now sharing in a bigger percentage or each. It may be that you're granting more broadly, and what I think employees sometimes get focused on what percent they have and they see that dilution, but what needs to be explained to them is actually you may have been diluted, but the pie is bigger, and so dilution isn't necessarily a bad thing. The investment coming in means the company's growing. We're all getting a slice of a bigger pie, and therefore it could be that dilution when looked at in the round, and obviously not making any promises about making anyone a millionaire, but that actually that represents the same value or more as it did when it was first granted.
Right. And then the preparing for, well, let's get into a little bit of data because this will help us couch the discussion as well. So here is the section on the global compensation data. And let's talk about the different levers so we're all starting with the same understanding. And Nicola, you let us know if any of this is different, and Nara, how you've seen this in effect. So we look at base salary, current bonus, which means it was paid. and then target bonus, which is out on the horizon for the next year. Typically, a bonus is a year, and that gets you to total cash. And I can't tell you how many times I've explained this, and then I still get a client asking me, why doesn't the base pay plus the current bonus equal the total cash in the numbers? And that's because the sample sizes are always different. There are many companies that get to their total cash just from a base pay. They don't have a bonus program. Nara, do you have a thought on that?
Yeah, I think this. You're absolutely right. I think it's some of these actually go back to the company stage, but also back to Nicola's point around cash in. So you're going to be very mean and lean early on, and as obviously things grow, and then you get greater dilution, which should dovetail and does dovetail to money coming in. Then you have to look at what value creation is about, and actually, well, then it really comes down to, and when the circle all comes together, is have you brought the right people, both founders, but also people coming in to create the value from the money coming in, because you need the money to create the value, but the value creation point is in execution. So yeah.
Yeah, so that's where the equity. So I think what you're saying also is that they could be in different relationship, because in the beginning, when you have a more equity and less cash, you may be giving some different lever of equity. And as things progress, and as Nicola, as you're saying, the equity becomes more really the gold, because you can see that the company has raised more capital. And so the equity is more scarce because it's worth more, even though you may have a lower percentage. So that's where you may end up giving more higher salaries. We see later stage companies are higher on the cash and lower on the equity, but that's to be expected because it's worth more. So here are the different components of equity: founder shares for those of you who are founders. And then we also survey founder shares for the current job. So that means if you're a founder CEO or scientific officer or medical officer, then you may very well get equity past your original founder shares, but that is different than a non-founder, somebody coming in from outside of the company. So let's look at some of this. Here is CEO, median total cash, US versus global by total financing. So this is Europe excluding the UK, because thanks to BIA, we have a separate UK bucket. But this is just to give you an idea. This really progression is the optics here to focus on, that as you raise more capital, you make more money. And almost everywhere, UK, you can see there's a little bit, I love this because this is like growing pains. You can see that the UK is not, which is why we extracted it, is that there's a little bit of a dip here at that 50 to 90 million. And it could be an anomaly because it's the early stage, but we like to show you real data. But there's no question how amazing that at the 90 million plus, the UK takes the lead on total cash. And here is the 75th percentile. So it's just at the median, because my other opinion on this, and Nara, you can answer this, is that probably some of the folks in the UK, especially in the life sciences, which is where the bulk of this data comes, if not all of it, are just so altruistic that they haven't gotten focused on the fact that it's not greedy to ask for more cash, and that you don't need to feel badly if you're leveling up your compensation. But then invariably, when you raise more capital and you hire more people in number two and number three, you're like, uh-oh, I have not been paying myself enough, and I need to now, because otherwise I'm throwing the whole thing out of whack.
Yeah, I think you're absolutely right about that. It's very interesting. That's a piece of data I wouldn't have expected to see that in the 50 to 90.
Well, it levels up here because the 75th percent people who were asking for the more all the way through had no problem doing it. In the US, we've already learned this, and in the rest of Europe, but in the UK, then here's where the story got straight.
Yeah, which is very interesting. I think that's absolutely right. And there is also what would be really interesting to see is the end numbers underneath these graphs, just to see what is the absolute value of each of those bars, which would be very interesting, because then it would allow for a little bit of comparison. And I don't know the answer to this. Is it the case that in the UK versus US versus Europe, there is a different number of people not fighting that pot of cash, but how many people are going for those jobs, and how many people are off
well, this
those
is the
jobs?
CEO. Our numbers are less, and we can definitely get that when we put out the results of this, but our numbers are definitely less. And that's why we keep asking for the participation. And that's why we've done the collaboration with BIA, because we believe fundamentally you've got to have this data. And the only way we get it is if people participate. So that's why we've been really generous in terms of the give to get model. But here's the equity component as well. And you can see that in the early stage of the US versus global by the financing, obviously, Nicola, this is where your expertise comes in. Obviously, there's dilution, and then there's been refresh. So you're keeping the median equity at the around 5%. And then you can see here in the UK that there's just a little bit of a drop off between. So this is where we have the data, right, is in that 15 to 50 and then the 90 million plus. So we're looking obviously to fill this in. But does this surprise you, or is this what you would, you're used to seeing?
Yeah, it would be interesting to see, what once you get the data in, what those other two bars look like. But I think we still see, and it is getting less and less, but that executives in the US are more focused on equity and value it more. In the UK, I mean, so we're getting there, but I think there still is sometimes an education piece to ensure that employees, especially in the more junior level, appreciate the value of their equity, because they're often accepting a smaller salary than they might if they went to work for Big Pharma. But the upside, the potential upside is much greater if they do value their equity. And as Nara, you were saying, these are supposed to be incentives, but they're not if people don't understand it. And so,
right. Well, here's an interesting one of a total cash for, and Nara, this has the sample sizes on it. This is for a scientific director, total cash, US and the biotech hubs versus the UK. I love this data, and I'm so thankful that we have it from everyone participating. And you can see that the sample sizes are very robust, right? I mean, the 39 for the UK, then Boston, Northern California, and Southern California. But you can see that in the UK, the total cash is less than the other hubs. And right now that may be the case. And at some point that may change depending on the competition for talent. And then here is the non-founder equity for the scientific director, right? Here's the same numbers. And you can see that the equity is lower in the UK, but not crazy, right? 0.1 versus 0.139 for a little bit of a legacy from the days when the Bay Area was really the place, and the Southern California has been growing too. But my guess is that the Boston area is going to continue to grow with this. So based on this data, Nara, talk a little bit about what you're seeing in terms of the competition for talent, where you're paying in terms of these percentiles, right? The 25th meetings. I think that sort of goes to what everybody was asking in their questions about how do you use these percentiles as you're hiring and you figure out where you want to be on the cash equity mix.
Yeah, 100%. I think I'll go back to one of my original points, which is around getting the right person for the job. So when you get your sort of scientific or sort of technical advisors, it's really not an easy thing to get right, particularly if you've got a technology that is not quite mature yet in its application per se. So discovery platforms, some AI models, dare I say it, when you're trying to find the applicability and your go-to-market strategy, getting that person in is not an easy one. You will have lots of incredibly smart people out there, with great academic connections, great knowledge in that space. But I would say, so there's lots of talent out there, but it goes back to being really, really clever as to how you're going to actually apply this to derive value. So I think the biggest thing, I'm not surprised by those figures. I think those figures sort of feel right, but both the difference between US and the UK, it's nearly half actually. They're not unreasonable. I think most people will look at those figures and go, yeah, they make sense in terms of their quantum. And very often, those sort of small equity pieces there also feel about right. It's always very difficult because when you start getting to percentage points of equity, going back to Nicola's point, if people don't know what that's worth, it can seem, what do you mean it's 0.1%?
Yeah, here's the data in a different format as well to show you the UK, Boston, Northern California. This is sort of a high level. And you can see that the UK equity is, you're right, about half, a little less than half.
Yeah. So, and I think that's sort of where it sits. So one of our challenges for the UK has been that we've got incredibly smart, incredibly talented people that are obviously in the Golden Triangle, but way outside the Golden Triangle as well. We've got, incredible world-class universities, in the north West, East, etc. So yes, the Golden Triangle produces a lot of talent, but I think it'd be incredibly foolish and self-restricting to restrict ourselves to that. So a little bit is around tapping into all of that knowledge base. We obviously tend to be quite academic, and the way our healthcare is delivered means a lot of expertise is staying within the NHS. One of our challenges, to your earlier question, Jodie, is how do we pull that into private enterprise and make that feasible and, to be honest, even fashionable thing to do? Answers on a postcard.
Well, that's a sort of the big difference. I mean, Nicola, I know you're smiling, but that's a big difference between the UK and the US, is that now more than ever with the new administration, that there is a push to really keep this in the private markets, right? It's meant to be for venture-backed companies, innovation. It's a formal lane, it's a career track, and that even people coming out of the FDA or the NIH are going to go to private companies or venture firms, and that it's not all going to be government funded. But in the UK, there is a different component there.
Yeah, we have much less of that revolving door that you see in the US. But as I was saying, we have so much great talent here in the UK, but sometimes the talent that a company wants to hire, even a UK company, is in the US. And so then, in negotiating with that executive, you need to kind of switch your brain and realize you're negotiating with someone from a different market. And, as we've seen, their expectations may well be quite different. And as a company, you may have to, if you want that person, you may have to flex to them, whilst kind of keeping true to your overall sort of principles as a company and fairness and things.
Right. And you may have different pay plans for two locations. So geography does matter. It doesn't matter what our data is showing. You don't see it as much at the top, but you do see it you don't see geography playing a factor in for top roles, but you do see it playing in for the more junior roles. And so here, for example, I'm going to show this data on a biotech CEO. By total financing. And this is, again, where we say the base pay and the bonus doesn't equal total cash, because not everybody is getting to their total cash just from a combination. Some people are getting to total cash just from their base pay, which is why it's not a straight addition. And you can see the dilution on the founder total equity, as you would expect. And the non-founder equity is really staying very consistent. So the data, this is where people were asking about the different percentiles. So this is the median. You got to figure out where you land on this. And the CEO's got to figure out where they're landing on it first and foremost, and then to adjust, because that's where the rest of your team is going to go. If you got to have a comp philosophy and a formula for how you're going to structure the team. And here is the 75th percentiles, as you would expect. The total cash is higher, but the non-founder equity, you can see very also interesting, is staying pretty stable once you get to that 30 to 70 in total financing. So the planning part of this is really important, and it takes all of your, Nara, you're talking about who you're going to hire. Obviously, this has to be factored in, right? Because if you're going to go higher on the equity, then you've got to figure out, are you going to sustain that for everybody? Is the CEO a first time, second time, third time CEO? Have they already had wealth creation? I mean, all of this is really important to focus on.
100%. And I'll just pull that together with Nicola's earlier point, which is around, if you're trying to look for talent, very often people are looking for the US. So we've got a very particular way in which we try and source talent from within academia and from within the NHS. So it is, you just have to walk the corridor in Harvard, MIT, take your pick, Stanford, Bay Area, and every academic institution, everyone will have a side hustle. There'll be an NED on a board, or there'll be advisors, etc. Whereas that's not a thing here so much. So we are not building that cache of, as in with an E at the end, that sort of cache of experienced board members, and within private company builders and entrepreneurs, as it's happening in the US rather. So I think that means that very often when you get to those more senior roles and the more experienced pieces, we very often then tend to look for the US, and then you have that issue. So that's something that with all the other workforce problems that are happening within academia and the NHS, is definitely changing. So I would probably say that in 5 years' time, here we go, here's a prediction. Maybe we do this
Yeah,
panel in
that's a
5
good
years,
way to
guys.
wind up.
But here we go. So that's the one. So in 5 years' time, I will put it to you that you will see a whole group, both mature but also younger people, coming out of academic and NHS institutions and training to look for private company engagement, whether that is in legal consultancy, pharma, small and big pharma, or startups or scale-ups, because people are making that shift. So it may be that our sort of socialized healthcare systems cost will become private biotech enterprise gain.
I would agree with you on that. Nicola, your thoughts on that? I mean, we're seeing obviously quite a bit of global economy, and it is a global marketplace. Life sciences has always been coming out of academia in both the UK as well as Nara said, and it's true, which is why, like, I mean, as I said, I sit here in Miami. You're not seeing that as a hub because we haven't had the same infrastructure here as you have in San Francisco, obviously in Boston. But that may be changing and that there is going to be, a transition, and there may be other locations popping up as well.
Yeah, I mean, I'm going to make a boring but important legal point,
Yeah.
which is, so apologies, I'll flag that up front. Don't switch off. If you're a UK company hiring in the US, or US hiring in the UK, or into Europe, or wherever it might be, it is important to think about the compliance piece, especially for the equity, because we were talking earlier about ISOs and EMI options. These things are different in every country, and if you grant your new US number two an EMI option with a penny exercise price, that is not going to work for them. There's going to be tax issues, and so it is important to get some advice. Your lawyers can help out with this, consultants.
You're the lawyer who's going to help out with this.
Well, yeah, your lawyers for me.
I would 100% back that up, actually, because it is absolutely fundamentally important to get this right. You should not be going off piste or try and do it yourself. It has to be both compliant, both from a governance point of view, but also from a tax accountancy point of view as well. And you want to, it's an incentive. So please don't do something for your potential members of staff that would be whacking them with a tax bill before they've even recognized any value. So,
well, it's showing you the numbers are only as good as you know what to do with it. The last thing I'm going to touch on, because I know we're going to wind up here, is first of all, it's all integrated and holistic, right? You've got a plan not only for the top people, but the staff level pay plans and the bands are really important because it means different things in different locations. And this just gives you an idea because we spend a lot of time here at Thelander, not only on the executive comp, because that's, job title by job title, but when you're putting in pay bands and you can see by the financing, it does matter. And this is now exactly what you had said. The more money going in, look at the difference of equity versus the difference of equity, and the cash goes up. So typically, this is where we had questions on this. You use the percentiles, but you got to plan for this. This is a senior scientist, an R&D scientist. We just wanted to show you the general, not the specific numbers, but the general tone of this. And this is where the planning is really important. And we didn't get into areas which, Nicola, I'm sure we could have a whole next webinar on change of control and severance and accelerated vesting and carve-out plans and all these other areas. So maybe we'll have to schedule another one. But the reality is that it's an integrated model. You got to know the numbers, which is where we come in. The Cooley component is you've got to have the planning because there are big differences and compliance between the different geographic locations, and they can have big implications in terms of tax and how you're hiring people. And Nara, you as the CEO, talking about who you're hiring, who's valuable when, because it shifts. And that's where the refresh and looking at your equity, which really, from my takeaway here, came to be the big tone of what is obviously the number one incentive for a private company. And then Wendy from BIA, who's been amazing, and you really sort of keep us all linked in. You're the arms around the whole organization in the UK to keep us focused on a mix of what's happening in terms of fundraising and financing and where the money's going, where it's coming from, and how that factors in as it relates to the strategy in the UK for innovation. Wendy, do you have anything going forward for us? Your last parting words of wisdom?
I mean, we've heard from our members that we have a very difficult funding environment. So it's quite hard to say, but we do know, like with the FDA changes, science funding, and tariffs, that investors are very cautious. So it's very hard to predict the rest of 2025.
Yeah. And Nicola, for you, for anything from the Cooley standpoint in your own practice?
Yeah, I mean, I think, hang in there during these times, and speak to your lawyers early about these kinds of things. It needn't be like a super expensive, piece of legal advice. Even just a quick chat can just ensure you're in the right direction, and or give you a, warning about, well, don't do that or do that.
Yeah. And my, of course, 2 cents for planning is participate, 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 because you get the data. You can see it's really helpful. It helps you make decisions. It's not the answer, but it's certainly, as Nara said, even though you may already know the answer, it highlights, and the more formality now, the better, because you don't want to wish that you had been planning earlier on. So it's never too early. I'm going to wind us up. Nara and Wendy and Nicola, thank you so much. And all of you who joined, we will follow up with a recording. And if you have any specific questions, please let us know. So thank you.
Thank
Thanks so
you.
much.
Bye.